I have a small fund portfolio where I do tactical trades, and this is to keep my hands busy and away from my core portfolio. When I see opportunities, I buy things which I look cheap. This is called my market crash shopping list. Now, given the big sell-off in markets recently, I thought it would be a good time to give you an update on what I think is a bargain right now. Now, don't forget, if you enjoy our content, please do subscribe to our channel. That way you won't miss any of our new content. So let's look at my market crash shopping list in a bit more detail. So why have a market crash shopping list in the first place? Well, when bad news comes along, everything is telling you that you should sell. And that's the opposite of the correct behavior. Because when markets sell off, you should think of that as a sale. All the assets which you like are now at discounted prices. So what you should be doing is buying, not selling. So the market crash shopping list helps you reframe sell-offs as a sale, not as an opportunity to sell. How do I choose the things in this shopping list? Well, it's completely personal. So firstly, these are things which I like. They may not be the things which you like. So certainly don't copy my market crash shopping list. But hopefully this will help you construct your own shopping list based on things you like. But the other critical component is when I buy. And that's based on when I see value. So throughout this video, you'll see me talking about valuation. So basically, it's the things which I like at the prices I want to pay. If you want to learn more about investing, why not join our membership? You can do that on PensionCraft.com. You get access to lots of goodies, such as our members-only videos and the application Slack, so you can ask a question whenever you want. To learn more about that, just click on the link beside me or in the description beneath me. The first item we're going to look at is Tritax Big Box. Now, this is a real estate investment trust. That means it can buy illiquid assets and it has a fixed amount of capital. If people pull out their money, it doesn't become a forced seller of those illiquid assets. What does it do? Well, it's essentially an infrastructure business. So they have a portfolio of high quality warehouses across the UK. And of course, along with that comes some prime strategic land. Notice how they tend to be distributed amongst the major thoroughfares through the UK. And that's because they lease out their warehouses to these customers. So for example, if you're having a package delivered via Amazon, it probably spends some time in one of these big box warehouses. Amazon comprises about 15% of the revenue from rents for Tritax, but you can see it also has things which are fairly defensive companies. So that would be companies like supermarkets, Morrison's, Tesco and so on, as well as some consumer discretionary companies like Argos. So there's always going to be a demand for these warehouses, and Tritax provides them. Now in May I bought some Tritax. You can see the timing of my trade with a dashed vertical red line. Why did I buy then? Well, it was just after Amazon had posted some pretty poor results. So you can see Amazon's share price here in blue. And after Amazon fell sharply, so did Tritax. Because Amazon had overstretched itself on its infrastructure and it announced it was going to start cutting back on that. Now, as we saw, only 15%-ish of the revenue for Tritax comes from Amazon. So I thought this was an overreaction and I thought it was an opportunity to buy. Of course, since then, the share price has fallen by another 30%. But does that mean I no longer like the company? No, not at all. Now, one way to gauge the value of a real estate investment trust is to compare the price of the REIT with the net asset value. That's the value of all of the stuff which the REIT owns. So on this graph, which you can see beside me, the net asset value, that's the value of all the land and warehouses which Big Box owns, is shown in blue. That updates infrequently, presumably because it's difficult to price all of that infrastructure. The red line is the price of the REIT. And if we divide one by the other and look at the difference in percentage terms, that's the bottom panel you can see here. So when Big Box is expensive, it goes blue in this bottom panel. That's when the price is above the net asset value. And when Big Box is cheap, it goes red. For example, in 2020, the price fell sharply, but the net asset value didn't. So at that point, it was trading at a big discount to NAV. Well, if you look at it now, you can see it's the biggest discount to NAV there's been since 2014. And that means that it's even more of a bargain. The dividend yield now is over 5%. So I think this is still a good buy. And in fact, I'm going to buy a bit more of Tritax Big Box. Now let's look at Scottish Mortgage Investment Trust. This is the UK's answer to Cathy Wood's ARK-K fund. You can see I've plotted both of them on this graph together, and they rose during the Pandemania rally hugely, and they both crashed after that Pandemania rally ended. That's because they tend to buy similar stocks, like Tesla. They also have a similar philosophy in that they go for disruptive growth stocks globally. However, you can see that Scottish Mortgage sold off less than ARK-K, which is shown here in green. And one of the reasons for that is that the governance, I think, for Scottish Mortgage is much better than it is for ARK-K. So if we do a risk-return plot where we've got risk along the bottom axis here with high risk on the right, low risk on the left, and return since 2014 on the y-axis with low returns at the bottom, high returns at the top, you can see that Scottish Mortgage has had very good returns compared with the Nasdaq, all of the ARK funds, and also the S&P tracker, SPY. Furthermore, the volatility of Scottish Mortgage Investment Trust is considerably less than ARK Innovation, the ARK-K fund. So higher return with lower risk. Again, this is an investment trust, so what we can do is compare the price of the fund with its net asset value. So net asset value in this top panel is in blue, and the price of Scottish Mortgage is in red. And again, in the bottom panel, you can see the price to net asset value, with discounts in red and premiums in blue. Well, currently you can see that it's at a discount of about 12%. The lowest it's been recently is a discount of about 18%. So that's certainly looking attractive in terms of price to net asset value. However, notice that there was a long period in the past, which lasted years, when this fund was trading at a discount. So if it's less popular, this is what you'd expect to see. So if growth completely falls out of favor, just because the price to net asset value is low, doesn't mean that this thing is a bargain. It might stay a bargain for some time. If we look at a trend of the increase in price of Scottish Mortgage going all the way back to 1994, the rate of growth is around 9.8% over the period leading up to the Pandemania rally. And if we extend that trend, you can see that it's currently slightly below it. So certainly on that basis, it is looking more attractive. A lot of the fluff that was baked into prices has now effectively been removed from the market. And because it's a growth company, I think it's interesting to look at the current premium that people in the US are paying for growth versus value. So the blue line here is the growth forward PE ratio for the S&P 500. The red line is the value forward PE. Now, people always pay a premium for growth, of course they do, but sometimes that premium just becomes crazy, as it did during the dot-com bubble and as it has again recently in the Pandemania rally. But if we look at the difference between the two, after the dot-com bubble burst, leading up to about 2002, that premium shrank to roughly the same size as it is right now. So a lot of the craziness, I think, has left the market. But growth is still relatively expensive in the US compared to history. Look at what happened in 2008. That premium for growth actually shrank to zero. And if we look at what's in the fund, these are the top 10 holdings, you can see a lot of it has fallen out of favor. Things like Tesla, things like Moderna. But notice there are also things like SpaceX, which makes up 3% of the portfolio. So this fund also buys unlisted stocks. Not a lot of them, but a lot of early stage companies which aren't listed yet on the stock exchange. So in terms of content, this ticks a lot of the nerdy things which I love. So it's definitely stuff I like. The question is the price right? And the price is kind of okay now. You can see it is at a discount. So I will be buying a little bit of Scottish Mortgage, but I won't be buying a lot. I think there may be better opportunities later on. A new item on the shopping list is US small caps. So if we look at US small cap valuations, there are two indices which you might look at in the US. One's the Russell 2000 index, the other one's the S&P 600. The S&P 600 is looking particularly cheap right now. That's the blue line you can see here. In fact, the only time it was this cheap, close to 10 times forward multiple, was around 2008's low point. The Russell 2000, the red line, isn't quite as cheap compared to its own history. Now, one of the things you have to be wary of with projected forward price to earnings ratio is the earnings number is a projected number. It's just a guess. And that guess evolves through time. And if the guess evolves downwards in time, suddenly the thing which looked cheap doesn't look as cheap at all. Now, if you look at the estimate for 2023 earnings for the S&P 600, That's been revised downwards, not hugely, but a bit over the course of this year. 2022's estimate is still going up, however. So at least some bad news I think is being priced into the S&P 600. I think there may be more to come, but it really depends how bad an earnings recession we get in the US, or if we get one at all. Now, why go for the S&P 600 rather than the Russell 2000? Well, there are some quality constraints on the S&P 600. Now, this is a research note that was published by S&P, so you have to be a bit careful about the comparison, but you can see that there are some quality filters. Things like profitability, things like liquidity, the amount of shares which are publicly floated, and the amount of time since the stock was listed on the stock exchange. So because of this quality filter, I think I prefer the S&P 600 to the Russell 2000. Now in the UK, there are several funds which give you small cap US exposure. The cheapest of them all is this one from Invesco, so that's probably the one I'll go for. The fee for that is just 0.14%, which is less than half that of the next cheapest fund. Another theme I like is batteries. But one of the fundamental problems with thematic funds is that everybody else likes it too. So what you end up doing is paying too much for those stocks. Notice how one of these funds, which is called BAT, which gives you exposure to the battery supply chain. So those are companies which directly manufacture batteries, but also the companies which provide the raw materials for those batteries. Notice how that surged in 2020 and 2021, and it really hasn't fallen much relative to the S&P since then. So this one I think is still too expensive, and I'm not going to buy any battery exposure right now. Another asset class I like is high yield credit, which you buy for a high income. But as always, the question is how much are you paying to buy that high income? Here I've got a high yield fund in the US, which I've chosen primarily because it's got a lot of dividend history. This is the Janus Henderson High Yield ETF. And in this top panel above me, you can see the price of that fund over time. Clearly, you're not going to buy this for capital appreciation. Its price has been falling since 2000. The reason you buy it is what's shown here in the middle panel, which is the income which it generates. And here I've shown the 12-month trailing dividend for that fund going back to 2000 as well. So price you can see varies day by day. It varies a lot. Whereas the dividend is fairly stable, and that reflects the current coupon of junk bonds in the US. So what you buy this thing for is the dividend. It's simply a question of what price do you pay for every dollar of dividend. So if we divide the dividend by the price, it gives us the dividend yield. That's shown in the bottom panel. And you ideally want to buy when the dividend yield is high. For example, as it was in 2009. Notice the dividend yield at that point went above 8.5% for this fund. And during the high yield sell-off in 2020, the dividend yield went above 7%. Now, if we look at the current dividend yield, it's above 6%, but it's nowhere near 7%. Once it does cross that threshold, I'll start to be more interested. But at the moment, I still think it's too expensive. It's not pricing in enough of a credit spread widening to make it attractive. Finally, let's look at copper, and here's the price of copper going back to 2012, and you can see recently it's sold off quite a lot. Now with commodities, it's hard to define a fair value, but what I've done in the bottom panel here is compare the GDP in China, which remember is a big buyer of copper globally, versus the year-on-year change in that copper price. Now if there is a big fall in Chinese GDP, you can see that usually it has a negative effect on the copper price. And in particular, the post-pandemic surge coincides quite nicely with the surge in Chinese GDP growth. However, at the moment, we've got a combination of rising policy rates from central banks all over the world. That's usually bad for commodities. And at the same time, we've got worries about Chinese growth. In fact, the publication of Q3 GDP for China has been delayed during the party congress for the Chinese Communist Party. Now, presumably, if it was good news, they wouldn't have delayed publication. So that certainly doesn't fill me full of confidence about Chinese growth. However, copper is an almost irreplaceable element when it comes to batteries, and there's going to be growing demand for those in future. So I suspect this will be an interesting one to keep an eye on. I don't think I'll quite be buying it yet, but there are a couple of ways of buying exposure, either through buying copper mining companies, or alternatively direct copper exposure via copper ETFs. But as I say, for now, I'm not going to buy copper. So there it is. There's my update to my market crash shopping list. Whatever you do, don't copy what I do because it's based on what I like. However, the approach, which is to look at things which you like and wait for the right price to come along, I think does make sense. Now, don't forget our offer of membership. You can join us on PensionCraft.com. There'll be more about that in the link beside me and in the description beneath me. And as always, thank you for listening.